So let's start the amendment session for the day. The ones who are writing your attempt in December 2021, please note your previous year is 1920 and your AY would be $2021. Yeah. So these are your tax slabs. This is just the same thing. There has been no amendment as such in the tax slabs, but just going through them quickly. So up to 60 years of age, 2.5 lakhs, nil, 2.5 to 5, 5%, 5 to 10, 20, above 10, it would be 30%. Okay. And 60 to 80 years of age, that is if they are 60 and above, but less than 83 is the basic slab here. Up to 3 lakhs, nil, 3 to 5, it becomes 5%, 5 to 10, 20, more than 10, it becomes 30. The ones who are 80 and above, we call them as super senior citizens. For them, up to 5 lakhs, basic exemption will be taken into account. So up to 5 lakhs, nil, 5 to 10 becomes 20, and more than 10, it becomes 30. There's been no change as such here. These are the slabs for your cooperative societies up to 10,000. Please remember, cooperative society, there is no such thing like a basic slab. Even up to 10,000, it is taxed at 10%, 10 to 20,000, 20%, and more than 20,000, it will be 30%. Firm, partnership firm, you have it at 30%, local authority also at 30. As far as companies is concerned, we'll have to go with a different set of rules here. First, we take up the previous year 18-19, that is the previous year, preceding previous year's turnover or gross receipt. If it is less than or equal to 400 crores, that is if they are medium-sized or small-sized companies, they get tax rate of 25%. More than that, it becomes 30%. In addition, we have two more other sections, 115 BAA and 115 BAB. As far as 115 BAA is concerned, those companies who are letting go of certain exemptions and deductions, that is, they say we will not claim certain exemptions, certain deductions, they will be eligible for 22%, and 115 BAB or your BAB, this is only for manufacturing companies who have started manufacturing after 1/10/2019. Please note, the details of this is only covered in your finals, so you don't have to really bother about these two here. This is your surcharge rate. There has been no change. It is the same as it was earlier. Rebate is also available for a resident individual. Very important. It has to be a resident and the income should not exceed 5 lakhs. Maximum rebate that a person can claim would be 12,500, and it is given before you add your health and education cess at 4%. Also note, if it is a long-term capital gain under section 112A, that is for equity shares or equity-oriented funds, which is taxed at a flat 10%, no rebate shall be given. So rebate is not available if it is having income of a long-term capital gain under 112A. Let's start with your amendments now. These are the major amendments. Now, I'm not just covering the ones which have come post-April. I'm also taking up the amendments which have come in the budget. So these would be your highlight or the questions that can be asked predominantly. Mostly they test whether you are aware of the amendments or not. There has been one major amendment post the budget, which has come in the form of a notification or a circular. I'll be taking that also. But major amendments were already taken up in the budget. Now we have two residential status, resident, non-resident. A third category has been added to calculate deemed resident. So a deemed resident will also fall under the category of resident itself as RNOR. So you don't have a separate status as a deemed resident. It shall only be included. But now a certain set of people will be deemed to be as residents. We have two basic conditions for resident to be in India. First is the 182 days criteria. So they should have stayed for a period of 182 days or more. And second criteria is 60 days in the previous year and 365 in the preceding 4 previous years. This condition remains the same. Please note, there has been no change in the basic conditions of 182 days and the second condition being 60 and 365. This is an either or condition. So even if one of the condition is satisfied, the person shall be referred to as resident. Here we're talking about individual. There has been an exemption for a certain category of people. That is, if an Indian citizen is leaving for employment, or Indian citizen or persons of Indian origin, if they are returning to India or they are visiting India, we only check on one condition, which is of 182 days or more. We need not bother about the second condition. Yes, we only check on the first condition for the exempted class. What is the amendment here? So now if Indian citizen or person of Indian origin, if they are coming to India and if their income is exceeding 15 lakhs, okay, and if their income is exceeding 15 lakhs, what income? Income excluding foreign income. I'll take up foreign income exclusions later. Let's understand the condition. So if an Indian citizen or person of Indian origin, if they are visiting India, or they're coming to India and they are having total income excluding 15 lakhs, then we'll have to check up a different condition for them also. Normal condition of 182 days, we do check, but now we will have to check an additional condition. What is the additional condition? Second basic condition is normally 60 plus 365 in 4 preceding previous years. This is in the previous year. This is in the 4 preceding previous year. Now we will have to check, instead of 60, it becomes 120. So they should have stayed in India, or they should have been in India for at least 120 days in the previous year and 365 days in the 4 preceding previous years. In that case, they again become a resident. Okay, this is for the exempted category. So in the exempted category, you had 3 categories. In that, this is applicable only to Indian citizen or persons of Indian origin who are coming to India, who are visiting India, and their income, which is excluding foreign income, should exceed 15 lakhs. What do you mean by excluding foreign income? Now, so what are we referring to here is foreign income exclusion, which means we're talking about a Indian income. If an individual is having any income from India, could be any source, could be any asset or accruing in India, it becomes Indian income. We take into account that. Also, if it is coming outside India, if the income is generating outside India through a business which is being set up in India, please note the business setup or management should be in India. So these 2 components put together would be income excluding foreign income. Indian income plus income which is generated outside India through a business which is set up or managed in India. That shall also be classified as your income excluding foreign income category. So if this 2 income put together exceeds 15 lakhs, then It shall be, the individual shall be eligible to again go through another condition of 120 days plus 365 days. Because you're subjecting him to additional condition, that is, earlier, please note this condition was not there. Now, because of the amendment, this condition is coming into existence. Let's take up three situations. If such category of people who are coming to India and their income is exceeding 15 lakhs, if they are staying for less than 120 days, they become non-resident. Because even a single condition, they don't satisfy. So if they're staying for less than 120 days, they become a non-resident. If they're staying for more than 182 days, they become a resident. Once they fulfill this condition, please go to the second condition and verify whether they are ROR or RNOR. Now, if they fall in between, that is, exceeding 120 days, but not exceeding 182 days, if they fall in between this category, because of this condition, you're making them a resident now. So it immediately means they will be called as resident, not ordinarily resident. We did not check into the second basic condition too. We did not go through the second set of conditions as well. Because of the amendment, they are now becoming a resident. So directly classify them as RNOR. If you all have any doubt, you can always use the chat box and let me know. Or if you want me to repeat anything, you can let me know in the chat box. Or at the end of the session, you can also ask me all your doubts. So now we have resident, non-resident, what we have seen. Deemed resident. Who becomes a deemed resident? First, they have to be Indian citizens always. Please note, only Indian citizens will be eligible to be a deemed resident. And the foreign income, or rather the income excluding foreign income, should exceed 15 lakhs. So in case of an Indian citizen whose Indian income and Indian business setup income is exceeding 15 lakhs, okay, and they are not taxing themselves as resident in any other country, they will be deemed to be as a resident in India. Now, what is happening here was, there were certain set of individuals who were making use of these days criteria and escaping taxation in all the countries. So what did the budget this time do? They said, if you are Indian citizens, now we are going to go by the citizenship too. If you are Indian citizen and your income from India or the businesses which are controlled and managed from India are exceeding 15 lakhs, and if you are not paying tax as a resident in any other country, you shall be deemed to be a resident of India, but as an RNOR. RNOR, the advantage that they get is their foreign income, which is not happening on account of any Indian activity, shall not be taxed in India. Okay, so they become RNOR. Let's take up a quick example and understand. Mr. Tejas, an Indian citizen, left India permanently with his wife and 2 children for extending his retail trade business of toys in Canada in the year 2015. From Canada, he is managing his retail business of toys in India. For the purpose of his Indian business, he visits India every year from 1st September to 31st January. His business income is 23.5 lakhs and 18 lakhs from retail trade business in Canada and in India respectively. For the year 2021, he has no other income during the previous year 2021. Determine his residential status and income taxable in the hands of AY 21-22. So for your previous year 2021, what will be his residential status? To see. I'll give you a minute quickly. Please type in the chat box, what is your answer? Please note, he is staying every year from 1st September to 31st January, which means September, October, November, December, and January. Roughly 153 days is his period of stay. He's having two income. So basically, he's an Indian citizen who's coming to India and staying for 153 days during the previous year. If an Indian citizen who is settled outside and coming to India, we only have to check for one condition of 182 days. Only if the income from excluding foreign income, if that is exceeding 15 lakhs, then we check on to the second condition of 120 days and 365 days. Let's see if his Indian income is exceeding 15 lakhs or no. Since the business is managed from Canada, we only have to see what is generated in India, the Indian income. The Indian income now happens to be 18 lakhs, more than 15 lakhs. So in this case, we will have to even check on your second condition of 120 days. So now we are checking not just one condition, but even the second one. So previous year is staying for more than 120 days. What about the 4 preceding previous years? He's returning to India every year is what they say. So from 2015, he comes every year and stays here for 153 days. So 153 into 4, more than 365 days. So it's definitely going to be more than 365 days, which means he is fulfilling the second condition. So if the second condition is fulfilled, what shall be your answer? Yes, what will be your answer for this? Very good. He will be RNOR, a resident, not ordinary resident. Why? Because he is not exceeding 182 days. Only if he's exceeding 182 days, we bother about being a resident or otherwise. So we check on to the additional conditions. This was the major amendment of your residential status. Let's move on to the next part of salary amendments. In salary, some major amendments have happened, especially by way of notification, which has come post-April, which was not there in the ones who wrote in June. It will only be there applicable now. I'll tell you which one is that. Let's start with this. So basically, what is this? Anyone who is working for a company can sometimes be eligible to get ESOP, employee stock option plans. It is also called as sweat equity because, you know, they put in their hard work, sweat, all khoon pasina types. So it's called as sweat equity shares as well. Sweat equity normally is taxed as a taxable perquisite in the year in which it is exercised, okay, by the employee, not the year of allotment. Whenever the employee is exercising his option to take. So if he's saying, yes, I'm willing to take this, I'm ready to pay this amount and willing to take these amount of shares, then it is said to become a taxable perquisite in the hands of the employee. Now, what? So this is already there in the act. Now, what has happened is, if in case they are eligible startup, there has been some benefit given to them. So eligible startups are those who are basically, you don't have it here in your intermediate. There is another section called as ATI, which is in finals. They get some kind of a deduction for startups which are eligible. So eligible startups are those who are manufacturing something using innovation. So those startups get the benefit here. What has happened here is they have postponed the taxability here. Why? Because valuation will be very difficult in the initial years for a startup. It is only when they later on grow, valuation can be clear. On the other hand, even the employees will have money to give it as tax. Initially, they would not even be having money to part with for tax purposes. So here they have postponed. What are they saying? after expiry of 48 months from the relevant assessment year. So 48 months would be 4 years. So after it is allotted, take back 4 years. So 4 years further on, later on, only this shall be taxed. Okay. Or if it is sold before 4 years, we shall tax it then. Why? Because they now have the money. So if it is sold before 4 years, it shall now be taxed then. Or if within 4 years, anytime the employee ceases to become the employee of that particular organization, yes, in that case, ceases to be the employee of the said employer. So if he is resigning from his job or the startup no longer exists, could be any reason, then in that year, whenever he is no longer the employee of that particular startup, they will have to pay taxes. So anything which happens earlier, any event which happens the earliest would have an impact of taxation here. Whatever is the taxable amount shall be taken as taxable per quisite. Normally what we do is we take up the market value, fair market value of the shares minus any cost which is being paid by the employee, that amount. So this amount will be calculated but shall be taxed only later on in the case of only eligible startups. This is your second major amendment in salary. Here we're talking about employer contribution only. Employer contribution only. Employers can contribute to recognized provident fund, to your national pension scheme, or to any other approved superannuation fund. Whatever they contribute is normally going to be exempt, subject to the individual section guidelines. For example, your recognized provident fund says up to 12% of salary, it shall be exempt. NPS says up to 1,50,000 of contribution, it shall be exempt. Superannuation fund, again, you have your 10% criteria. So individual sections have these criteria and we are going to see into that. What is this amendment now saying is, we are going to put an upper cap. Individual sections, yes, it is there. Now we are going to put an upper cap. Put together. Take up your contribution, the employer contribution in RPF. Add up your NPS contribution, add up the superannuation fund contribution. Put together, if it is exceeding 7.5 lakhs, it is an upper cap. That excess portion, we are only talking about the excess portion here. That excess amount shall be taxed as a perquisite. Okay, so we're not talking about till 7.5 lakhs every year, no problem. Only if it is exceeding that amount, it shall be taxed as perquisite. Now, what was happening here was, because of the change in the way salary is being given now, many people started getting a lot of employer contribution here. And the government realized that instead of taxing it, it is going all exempted more than what they intended. That's why you have an upper cap. Not just this. So say, for example, 10 lakhs is the total contribution which is coming from all the three. 7.5 lakhs is your upper cap. 2.5 lakh shall be taxed as perquisite. Along with this, any interest, any dividend, any other income which is accruing on the excess portion shall also be taken as a taxable perquisite only. I'll just repeat that. So anything which is over and above 7.5 lakh will be a part of your total income as perquisite. This is clear. Anything which is accruing to the balances, okay, could be of any of the fund, PF, NPS, or superannuation fund. It could be in the nature of dividend, interest, or some other similar natured income that shall also be included in the total income as a perquisite. Okay, so like in the example, we saw 2,50,000 is addition. So on that addition bit, whatever is your interest, dividend, or any other thing shall also be included in the perquisite calculations only. Till here, till this portion we had already seen in the classes, in the budget sections, right? What has now come is your calculation. How much is going to be calculated? This is your new amendment. And they have given a formula. This has come by way of notification. Please pay attention here. It says taxable perquisite. TP refers to as your taxable perquisite. So taxable perquisite will be equal to something. Now we'll just break down this formula and understand. First, let's break down this formula actually. What are they saying is, for the people who are writing for the previous year 2021, okay, so for your attempt who are writing in December, you need not bother about the second part of the formula. You need not bother about the second part of the formula. If you focus on the first part, it is sufficient for the ones who are writing in December. Next year onwards, the full formula will be applicable. Why is that? Now, PC. Now, PC refers to the excess portion of over and above 7.5 lakhs. So in our case, the excess portion was 2.5 lakhs. So we're talking about only the excess portion. Okay. So we're having taxable perquisite is equal to excess portion here, 2.5 lakhs, divided by 2 into R. Into R. Now, what is this R? R is not just what we understand as rate. No, here it takes a different meaning. It says R is equal to I divided by F average. I divided by F average. I'm expecting a short MCQ in this area because one, your formula gets half for your attempt. So please pay attention. I is saying as whatever is aggregate amount which is accruing. So whatever is your interest, whatever has accrued, say if it is interest, dividend, whatever, what is accrued, divided by balances on the first day, okay, balances on the last day, divided by 2. Please notice there is a small 2. What do I mean here? F average is nothing but opening balance of the fund. If it is RPF, say opening balance of the RPF for the year, plus closing balance of the fund divided by 2. That's all. To put it simple, it is that's all. Yes. Now we'll also understand the second part of the formula. We'll also do a problem so you get even more clarity. PC1, okay, is the excess contribution of the earlier years. Please note, excess of 7.5 lakhs, whichever has come on or after 1/4/2020, other than current year. So this is for previous year 2021. If you're talking about previous year 21-22, your PC1 would be nothing but whatever you had put to tax as TP earlier. Okay, so whatever you had taken up as tax contribution earlier, that amount will be coming here. And your TP1 is whatever you have taxed earlier into R. R is what we have seen. So PC1 would be earlier year's contribution, which is more than 2.5 lakhs, sorry, more than 7.5 lakhs. TP1 is earlier year's taxable perquisite. R remains the same. Interest divided by F average. Please note, the second part of the formula will not be relevant for the previous year 2021, as this is the first time you are having this kind of an amendment here. So it shall not be applicable. Let's take one problem and quickly work through this one and see. Suppose X Private Limited contributed 8.5 lakhs during the previous year 2021 towards recognized provident fund to the account of Mr. A. Mr. A has also made an equivalent contribution. Balance as on 1/4/2020 of RPF is 32 lakhs. Interest accrued during the year is 3,44,250. The taxable perquisite shall be computed in the following manner. Let's understand how it shall be done. Now, our formula is TP is equal to PC by 2 into R. Taxable perquisite is equal to PC by 2 into R. Yes, it is as simple as this. We have to ignore the second part of the formula. Why? Because it will not be applicable here. That is for the previous years. Since this is the first year of taxability, we did not even bother about this. So we can only take up the first part of the formula. TP is equal to PC by 2 into CR. Now, PC is nothing but excess contribution. Okay. PC is equal to the excess contribution over and above 7.5 lakhs. Total contribution is 8.5 lakhs. So the excess is 1 lakh. 1 lakh divided by 2 into. Now comes your R. R is nothing but I by F average. Okay. Now, what is I? What is F average is what we have to work out for. I we already have interest accrued during the year. So I is already there with us. It is 3,44,250. I we already have. F average is the opening balance of the fund plus closing balance of the fund divided by 2. Do I have the opening balance of the fund? Yes. So opening balance is 32 lakhs. I already have it. Do I have the closing balance of the fund given? No. But can I calculate? Yes. How do I calculate? In the opening balance, there would have been additions during the year. Additions by way of contribution. Employer contribution as well as employee contribution. So employer contribution of 8.5 lakhs, employee contribution of 8.5 lakhs, and interest of 3,44,250. Yes. So this has been the total contribution during the year. If you total up, this will come to around 52,44,250. I have the opening balance, I have the closing balance. I can find out the average. So average would be 32 lakhs plus 52,44,250 divided by 2. So this amount divided by 2, roughly it will come to around your 42,22,125. And now I will get the rate. R will be 0.08153. So 1 lakh divided by 2 into R, 0.08153. This will now be my taxable perquisite. So taxable perquisite, if you calculate, this will come to around 4,077 rupees. Yes, I hope this is clear. Since you have to only talk about first part of the formula, it is easy. Just understand it once again. We are breaking down the formula into 2. Though the formula is in full, for the attempts that you're writing, only the first part shall be applicable. Why? Because this is the first year. This is for previous years, preceding previous years after 1/4/2020. So this, we don't have anything after that. So we can ignore this bit. We're only talking about the first one. So even here they say it will not be relevant for your particular AY. Then transfer pricing will be PC by 2 into R. So as far as salary is concerned, we have these amendments. Let's take up next one as your house property. House property, there is no amendment. It's just an alternate view which is given in your module, study material, ICAI material. What they say is unrealized rent. Normally what we do is we compare your expected rent with the actual rent. So expected rent is after getting your standard rent, fair rent, municipal rent. After giving a comparison of all the three, we compare this with your actual rent. The actual rent that you take here is after deducting unrealized rent. The alternate view given is that, so we generally say gross annual value is whichever is higher, expected rent or actual rent, whichever is higher. So normally what we have been doing is we have been deducting your unrealized rent from the actual rent. Alternate view is you can also deduct it from your gross annual value. Please note, this is just an alternate view. If it is too confusing, you can even ignore it. This has been given. Why? Because the income tax returns have started permitting such kind of deductions. So interpretation has been a little different here. Let's move on to the next head of your PGBP head. Under PGBP, we have one major removal of a section 32AD. So we had this section earlier. Okay. I'm talking about previous year 1920. We had this amendment, or rather we had this section working in 1920. But as soon as it came in 2021, this has been removed. So in 1920, what was the section? 32 AD said that if a manufacturing unit is set up in any of these states, West Bengal, Andhra Pradesh, Bihar, Telangana, they shall be eligible for an additional deduction of 35%. Okay, this was there earlier. This was there earlier, but now this has been removed. Now it is being removed. Instead, they're having the regular additional depreciation, which is 20% of cost of machinery, subject to the machinery being under the eligible category. Now, in additional depreciation also, if it is put to use less than 180 days, we give them only half during the year and half in the next year. Same thing will happen here. In case, if any asset was put to use in the second half or less than 180 days in the previous year, 1920, in your year, you will have to give them the balance 50% of your deduction, which is 17.5%. Okay, the balance will come here. I've taken a small example to understand this. Let's do this. Suppose a machinery is purchased in the state of Karnataka and the date of put to use, purchase and put to use happens to be 1/4/2020. Okay, if it happens to be 1/4/2020, how will you calculate additional depreciation as? Additional depreciation will be calculated as 20% of the machinery, of the cost of the machine, right? Yes, 20% of the machinery cost. If it is in Telangana, please note this is previous year 2021. This becomes previous year 2021. If it is in Telangana and if it is bought on 1/5/2020, again, it shall be 20% of machinery only. So additional depreciation will be 20% of cost of machinery. No change here. Okay, let's take up the second case. If it is put to use for less than 180 days in the previous year, 2021, because it is purchased in 1/3, March, we will give only 10% in this year, 10% in the next year. So 10% will be given in the previous year, 2021. And if it is in the state of Bihar, same thing, 10% in this year, 10% in next year. So in the previous year, 2021, you will be giving only 10%. No change here. Then where is the change actually? It is here. It will come here in the state of Karnataka. If it is bought on 1/3/2020, this is previous year 1920. This is also previous year 1920. If it is bought in the previous year 1920, they would have been eligible for 20% of additional depreciation. 10% they would have claimed in 1920. So 10% they would have claimed in 1920. Now give the remaining 10% in 2021. Had it been in the state of Telangana, they would have claimed 17.5% in 1920. And this amendment comes only if it is put to use after 1/4/2020. So that means even then, this machinery is still going to be eligible for the additional rate only, subject to it being put to use in the previous year 1920. Only thing you have to remember, if it is in these 4 states and the asset is put to use in 1920 for less than 180 days, give them additional depreciation of 17.5 and not 10. I hope with this example, this will now be clear. The second amendment is in terms of car. Now, there has been a new block which has come for car if they have been purchased during the period 23rd August 2019 to 31/3/2020. Please note 1920. Okay, even though it is bought in the year 1920, they will still continue enjoying the additional rate. So in car, you will have 2 blocks, 30% block and 15% block. If it is running on higher, you will have a 45% block and 30% block. So if the machinery, if the car could be motor, lorry, bus, taxi, could be anything, okay, car or taxi. If it is procured and put to use during this period, then they will enjoy an additional depreciation. As you recall, the motor industry, automobile industry was not going through a very smooth phase. It was going through a rough patch, and that time they had given this kind of an incentive for people to invest in different vehicles. So we have 2 blocks and they continue being in that category itself throughout for all the years. Let's move on to the next sections of PGBP. Earlier, for your scientific research, we had to classify them into different categories, whether it is in-house or not, and so on. And we had to give them weighted deduction. Now it is very simple, no weighted deduction. Whatever you are spending on research purpose, claim 100% of that as deduction. There is no element of weighted deduction here. Yes? 35 AD, deduction in respect of specified business. Now, if you recall, you had your cold storage and all those things here. What is the amendment is, it is now made optional to the assessee. Okay, it is now optional to the assessee. If they want, they can claim it, otherwise no. Only if they claim in the IT return, it shall be taken as they have claimed it, otherwise no. Now, why has this amendment come? Because if anyone wants to opt for 115 back or your new tax regime, they will have to let go of certain deductions, and one deduction that they have to let go will be 35 AD. So if you want to opt for those sections of new tax regime, you will have to let go of these ones. That's why it's made optional. 35D, which talks about amortization of preliminary expenses. Here, the amendment is, in the first year of claiming the expense, they will have to furnish a tax audit report. That is, audit report from a chartered accountant within the due dates mentioned. Due dates have gone for a huge change here. For every year, the due date is now become, for audit purposes, 31st October is the date of return filing, and 30th September is the date for report filing. Okay, so report has to be furnished by 30th September, return has to be furnished by 31st October. But For this year, it is now changed to 15th February 2022 and 15th January 2021. Okay, 1 month is your report filing period. 1 month prior becomes your report filing period. This is for audit cases. Wherever there is audit non-applicability, the date is now 31st December 2021. These are your new dates as far as now, which is being notified. Another amendment which has come is in your tax audit limit. So now they have made the tax audit limit to 5 crores. Earlier it was 1 crore. They have pushed it to 5 crores. Okay. So from 1 crore, the audit limit goes to 5 crores. This comes with a star, subject to 2 conditions. Okay. It is 5 crores subject to 2 conditions. First, aggregate cash receipts in the relevant previous year should be less than 5% of total receipts. So basically they want it to be moving towards a cashless economy. That's why all the cash payments and cash receipts are not encouraged. They say total up your receipts. 5% of that compare with your aggregate cash receipts. Is your aggregate cash receipts less? Then you fulfill condition number 1. Total up all your payment. Take 5%. Compare that with your aggregate cash payments in the last year. Okay, including all the expenses. If it is less, you fulfill the second condition. And once you fulfill both these 2 conditions, now your turnover criteria becomes 5 crores. If you are not fulfilling even one of the conditions, you straight away fall to 1 crore. But when you come down, a 2 crore, you get a small cushion of presumptive income. If you have opted for presumptive basis, then it becomes 2 crores. If not, fall down again.
Ma'am?
Yes?
The audit limit for profession is 50 lakhs. No,
Audit for profession is 50 lakhs. Yes, there's been no change there. It still remains at 50 lakhs only.
Thanks, ma'am.
Capital gain amendment. Now here, always remember your base year is 1/4/2001. No change there. This is still the same. And we've been calculating the cost or fair market value, whichever is beneficial to the assessee. Obviously, whichever is beneficial is what he will take for. What is the amendment? Is now we have to take for immovable property. We have to also take up the stamp duty value as on 1/4/2001 wherever applicable, which means you can take up the fair market value, but it should not exceed the stamp duty value as on that date. Let's take a small example and understand. Say, for example, cost happens to be 8 lakhs. A land is bought on 1/4/1999. Okay, so cost is 8 lakhs. The fair market value on 1/4/2001 happens to be 12 lakhs. So, but obvious, when the person is selling, they will take whichever is more beneficial for them. This happens to be 12 lakhs. The amendment is on this date, also check what is the stamp duty value. Say, for example, the stamp duty value happens to be 10 lakhs. Then they say you can only take up the stamp duty value as the amount. It should not exceed the stamp duty value. So in this case, 10 lakhs is what you will have to restrict it to. Of course, if the stamp duty value is more, you can also avail that amount because it is more. Slum sale, whenever there is a slum sale, if you remember, it is selling away the entire undertaking as such, not an asset by asset. So here we have to calculate the net worth and accordingly get the cost. a report has to be furnished for this lump sale. The CA has to certify, yes, all the reporting of capital gains is in order. And of course, as per the due date. Due date is 30th September for all the years. For this year, of course, it is altered to 15th in their report. Reporting date would be 15th January. Return filing date would be 15th February for audit cases. Here, I'm taking up three sections together. We're talking about 50C, 43 CA, and 56 to 10. Now, what is happening here? If there is any sale, of immovable property, okay? If there is any sale of immovable property, say a land and building, it is being sold. Take up the sale value. Take up the sale value and give an increment of 10% on the sale value. Make your sale value as 110%, add 10 more percentage, and compare that with the stamp duty value on that particular date. If the stamp duty value is more, in spite of adding up the 10%, if the stamp duty value is in excess, then stamp duty value shall be deemed to be the full value of consideration. Okay? If it is a capital asset, capital gains will be affected. If it is a stock in trade, if land and building is a part of your stock in trade, then your PGBP income shall be affected. Yes? 56 to 10 for now, I'll take up later. So we are understanding this one. We're taking up the sales value, increasing it by 10%. 110% of the sales value is what is to be compared with the stamp duty value. If still stamp duty value is more, then stamp duty value shall be deemed to be the full value of consideration. Let's take up an example here and understand this. I've taken up different stamp duty value and different sales consideration. This is your actual sales consideration and stamp duty value. We are going to add 10% more to this. So here 38 lakhs plus 3,80,000. So 110% of your stamp duty value. How much will this be? In this case, it will be 41,80,000. Let me just fill up this 110% of consideration column. It will be the same. Here, 3,50,000. This will be 38,50,000 for all the cases. Now, we have taken up the sales consideration and we have added 10% to it. We've got 110% of sales consideration. This sales consideration, we have to now compare with the stamp duty value. Give a comparison between these two amounts and then decide what shall be your actual or your deemed sales consideration. Yes. Now here, 41,80,000 and 42 lakh. Stamp duty value is high. It is higher than even 110% of consideration. So stamp duty value shall be deemed. And 42 lakhs will become the deemed sales consideration. Take up the second case. 41 lakh and 41 lakh 80,000. Here 110% of the consideration is more, which means your actual sales value itself can be taken to be as the sales consideration. Yes. Once your 110% is more, you can stick to your actuals. 39 lakh, 38 lakh, 50,000. What is high? Stamp duty value. So take up your stamp duty value as the deemed value for consideration. 38 lakh, 50,000. Since it is 38 lakh, 50,000, we go to actual amount. 30 lakhs is lower than the actual itself. Still we'll stick on to the actual itself. Yes. So this is how you will compute your deemed sales consideration in case stamp duty value happens to be high. As far as 50C and 43CA is concerned, we apply the same thing for both. 56(2)(10). So if anyone has received an immovable property for inadequate consideration, now we have to see what is the difference. In monetary terms, it should be more than 50,000, and in calculation terms, it should be 10% of consideration. So we have to compare with the stamp duty value. Say for example, 5 lakh is what is being paid for the property. 7 lakhs happens to be the stamp duty value. Difference is 2 lakh, more than 50,000 or more than 10% of the consideration. That difference shall be taken as income from other sources. Yes, 56(2)(10). Your gift section will become taxability here. Let's move on to income from other sources. Dividend is now become fully taxable. Earlier, we used to have certain exemptions. Now it is fully taxable. Once it becomes fully taxable, your TDS will also be applicable. So please remember, TDS also will be applicable. I'll take up the TDS separately when we are doing TDS amendments. Earlier, companies used to pay dividend distribution tax. That's why it was exempt in the hands of shareholders. Now, because shareholders itself are paying tax, companies need not pay any dividend distribution tax. Earlier, only domestic companies were paying DDT, so only those share dividends used to enjoy benefit. Now, since the benefit itself is not there, there is similar treatment for both domestic dividends as well as foreign company dividends. Mutual fund dividend is also taxable. Yes, so your 56 chargeability is now added up dividend too. Earlier, we used to have even slabs of 10 lakhs and all of those things, everything gone, fully taxable now. It has become very simple, fully taxable. One deduction that you can claim here with respect to dividend is interest. Only interest expense is allowed to be claimed as deduction. That too subject to maximum of 20%. Say for example, dividend amount is 1 lakh. Okay, your interest paid during the year is 24,000. Interest paid and dividend earned. So dividend received is 1 lakh, and for earning this dividend, you had to invest in shares for which you've taken a loan, and the interest amount comes to 24,000. So here they say actual or 20% of income, which is 20,000. Take whichever is lower. Only you can give that amount of deduction. So remaining 80,000 shall be charged to tax as dividend. Maximum of 20% of dividend is what you can claim as deduction, that too only interest income. The next one is your ATEEA, deduction in respect of loan, that is interest on loan for residential house property. Please remember, this is over and above 24B. So what you're getting there for self-occupied property is 2 lakh. This is over and above that. This is 1,50,000 as the quantum. Now, stamp duty value of the house should not exceed 45 lakhs. Okay. And it should be sanctioned. The loan should be sanctioned between the period 1/4/2019 to 31st March 2021. This should be the loan sanction period. This has been extended. That's why you have to be even careful. And they should not own any other property on the date of loan sanction. So we can also claim under 24B and ATEEA as well. Few more amendments in the deductions. ATG, your PM Care Fund has been now taken up addition to. It is qualifying for 100% deduction without any qualifying limit in the first category, category 1. Yes, your PM Cares or Prime Minister Citizen Assistance and Relief in Emergency Situation Fund. This is also now brought under the first category of 100% deduction without any qualifying limit. In order to claim ATG, now the donor should file a Donee should file a statement. Only based on that, they will be eligible to claim deduction. Also note, for 80 GGA also, now no more cash deductions, cash donations of more than 2,000 will be given as deduction. So up to 2,000, no issue. But from 1/6/2020, they have to give only non-cash donations or in permitted modes. And from the last year, they have also added officially all your UPI payments, net banking, NEFT, everything is now being added. Before 1/6/2020, the amount was 10,000. Post that, it is now 2,000. Most important, 115 back. So a new tax regime had been introduced, and this is something like this. What is applicable for you is 115 back, which is for individual and HUF both. Here the slabs are totally different. Up to 2,50,000, it is nil. There is no age criteria here. Simple, same thing for all. Every 2.5 lakh, the slab changes by 5%. Okay, so 2.5 lakh to 5 lakh, 5%, 5 to 7.5, 10%, 7.5 to 10, 15, 10 to 12.5, 20, 12.5 to 15 becomes 25. Post 15 lakhs, it is 30%. Please remember, this is 10 lakhs in your old regime, and new regime, as we call it as, it is 15 lakhs. Any individual or HUF who is opting for 115 back should let go of certain deductions or exemptions. Here is a list of what they have to let go. Leave travel concession, 10.5. HRA allowance, not allowed, 10.13.8. Special allowances other than those prescribed. So prescribed ones are only 3 of those ones. Only they will be allowed, nothing else. Daily allowance to MP or MLA is not allowed. Minor child income exemption, 1,500, not allowed. 10AA, tax holiday for SEZ on the export profit, not allowed. All your 16 deductions, 16, 1, 2, and 3, not allowed. Standard deduction, 50,000. Entertainment allowance, which was given for government employees, 16.3 professional tax, no such deduction shall be given. 24B, interest not allowed. 32(1), additional depreciation. Depreciation is allowed. Additional depreciation not allowed. Scientific research donations not allowed. Specified business, that's why it's made optional. If anyone wants to opt here, you can let go of this one in 35 AD. Agricultural extension projects, deductions not allowed. Family pension, the maximum of 15,000 which they get, not allowed. All your chapter 6A deductions, which was based from ATC to ATU, only other than National Pension Scheme, ATCCD 2, the additional deduction part, and JJAA, only this is permitted. Other than that, nothing is permitted here. So all these deductions will not be allowed under 115 back. Not just that, any other loss that you have been carrying forward, or if there is unabsorbed depreciation from earlier years because of these deductions, even that you cannot claim. House property loss can only be set off against house property income, not against any other head. And the maximum depreciation that a person can claim in a block shall be restricted to 40%. So anywhere where you're seeing 45 and anything shall be restricted to 40% itself if they are opting for 150 back. A question on the nature of comparison between new tax regime 115 back and the old tax regime is more likely. Okay, so please focus on those questions. Now, they have classified this 115 back for 2 sets of income. It is given an income classification here. If an individual HUF has PGBP income, then once if they opt, They can only opt out once. Re-entry is not possible. So if they're opting for 115 back, if they feel tomorrow that this is not working out for them or they are paying much more than what they intended, they can opt out. But re-entry is not permitted. No re-entry is allowed. If they have income other than PGBP, only salary income, only house property income, then year on year basis, they can decide whether they want to opt in or opt out. It is completely their choice to decide year on year. Whatever is decided has to be made before filing your return of income. If in case any condition is not satisfied, probably they have still availed some kind of a deduction, they are not complying by any of the condition, then if they had PGBP income, it shall become invalid for not just that 1 year, but all the subsequent years as well. If they have PGBP, then the option will be invalid only for that particular year. For PGBP income, please note, for the relevant year, also the subsequent years. Yes, because PGBP will have your depreciation and all those impact, which will even have an impact in the later years. If 115 back is opted for, alternate minimum tax will not be applicable because pretty much they are not claiming those exemptions itself. So therefore, AMT, they will not have to pay any taxes there. Now we have our tedious amendments. There have been about 4 or 5 amendments here. Because of your COVID or pandemic, one relief which was given was in terms of your tedious rate. They said only 75% of the existing rate, if you deduct tax and deposit, it shall be enough. This was given in order to ensure liquidity crisis does not arise. So from 14th May 2020 to 31st March 2021, 75% of the existing rate shall be applicable for major of the sections. Now, there were certain sections like 194C, 194H, J, I. Here, they used to mention audit. You know, last year, if the individual is subject to audit. Now, because the tax audit has got a broader meaning of 5 crores, 1 crore and 2 crore, to avoid confusion, they have changed the wordings to turnover. So if the individual has a turnover of 100 lakhs, which is 1 crore for business and 50 for profession during the preceding financial year, immediately preceding the relevant previous year. In other words, preceding previous year, not the previous year, but preceding previous year, then for them, tedious provisions shall be applicable. As I said you earlier, since dividend is now taxable, TDS on dividend has also come. It shall be deducted at 10% by the officer. Of course, 7.5% if it is in those dates. If anyone is getting less than 5,000, individual shareholder, if they are getting less than 5,000, no TDS, but it should not be paid by cash. It should be other than cash payment. Also, if it is paid to LIC or General Insurance Corporation or any of their subsidiaries and such insurers, no TDS will be applicable to them. In 194C contract, meaning is now changed. In case anyone is doing any kind of manufacturing according to specifications of customer, say for example, a person is, say, Mr. X. Mr. X is now stitching any kind of uniform for a company for all the employees of A Limited. So A Limited is giving them specifications. You will have to stitch accordingly. Not just that, they are also supplying the raw material. So A Limited, by using material from such customer itself. So A Limited is giving the material and saying We will take the material also from us, and this material is what you have to stitch and give it to us back. So this will also be taken to be as a contract nature itself. Okay. If there is any other related party of A Limited, even they, if they are supplying material, say for example, they have a parent company, P Limited. So parent company, if they are supplying the material, even then it would be deemed to be in the nature of contract itself. TDS provisions shall be applicable. In terms of 194J, now they have bifurcated the rate for technical fees and for other services. So in case if it is technical services, it will be 2%. If it is others, it will be 10%. But for royalty, only in the case of distribution of films, exhibition of films, or sale of cinematographic films, it becomes 2%. Other royalties would still be at 10% only. We have seen TDS in respect of dividend. This is in respect of units. So we are talking about dividend which is being given by the mutual fund. So mutual fund or any other company, your asset managing company, if they are giving any dividend, again deduct a 10% if it is exceeding 5,000. They might sometimes not give it as dividend, but by some other name. No matter what name you call it, it shall be applicable. Of course, other than capital gains. It should not be in the nature of capital gains. 194N, your TDS on cash withdrawal, is also undergone a small change. Earlier, what used to be there, if the cash is being withdrawn by the client, okay, if you go to the bank and if the customer is withdrawing more than 1 crore, 2% shall be the TDS which will be applicable. So this is basically banks, cooperative societies, and post office. If their customers are withdrawing cash more than 1 crore, over and above 1 crore, unlike the other sections, only over and above 1 crore TDS shall be applicable. What has happened here? From 1/7/2020, bank have to now check if the customer, if their customer who is withdrawing the amount, have they filed return for all the 3 assessment years relevant to the 3 previous years. Okay, they have to see if they have filed the return of income or not. Based on that, the rate will change. Now, how can bank have access to their return of income is, they have come up with a portal access to the banks. So banks have been given the income tax e-filing portal access of a limited section where they can just enter the PAN number and come to know what is the filing status of the person. So in case they have not filed, then up to 2 lakhs, no TDS. Sorry, up to 20 lakhs, no TDS. 20 lakhs to 1 crore, TDS shall be applicable at 2%. If it is exceeding 1 crore of cash withdrawal, TDS shall be applicable at 5%. This is all to ensure that they are not having much of cash transactions. Let's take a small example and see here. Dr. Sargun maintained 2 bank accounts, one current account with Canara Bank for her profession and a savings account with State Bank of India. Following are the details of her withdrawals from these accounts during the previous year, 2021. So total of Canara Bank comes to 1 crore 20 lakh 20,000 and SBI comes to 45 lakh 63,000. She furnished her return of income for AY 2021 and 1920 before the time limit, but for the earlier years, she has filed her income belatedly. But she has filed it, even though it's a belated return, she has filed it. Is any tax deductible at source under section 194N on the withdrawals made by Dr. Sargun from Canara Bank and SBI Bank? If yes, at what rate and what amount? So I've totaled only ones which are coming after Total is for the whole thing. Yes. So please remember this 20 lakhs, 1 crore, whatever you're seeing, it's bank-wise limit. Since this amount is less than 1 crore, we have to only see whether the return has been filed or not. 3 years return has been filed by her. So SBI withdrawal, no TDS. Canara Bank is exceeding 1 crore. So yes, TDS will be applicable here. On what amount? On any amount which is exceeding 1 crore. So till 1 crore, no TDS. If it is exceeding, so on 20 lakh 20,000, TDS shall be deductible by the bank. Comes the question, what rate? Since the return has been furnished, we can take 2%. Otherwise, we will have to see 5 or whatever. So 2% 2020. And this will be this one, 2022% Canara Bank. Option C, which will be applicable here. A new section has come with effect from 1/10/2020, that is 194O, payment by e-commerce operator to e-commerce participant. What is this? Say, for example, Mr. X have listed himself on an e-commerce platform like Amazon. Yes. So Amazon is doing all the listing for him, and any sales which happens, the sale consideration will go to Amazon. Amazon will then give it to Mr. X. Mostly it happens in that way. If this sales consideration exceeds 5 lakhs, okay, if this sales consideration exceeds 5 lakhs in the case of an individual or HUF, in that case, they will have to start deducting tax. For if it is other than individual HUF, no amount here. But for individual HUF till 5 lakhs, no TDS shall be applicable. At what rate? At 1% of the gross amount. Okay. If PAN is not furnished, of course, we take up 20% itself. Now, say Amazon is made a payment of 4,50,000 during the year to Mr. X. If any customer has made any direct payment, even though they're buying from Amazon, but the payment has gone directly to Mr. X, say 1 lakh is gone directly. In that case, Amazon will have to take into account this direct payments also. 4.5 lakh plus 1 lakh exceeds 5.5 lakh. So this is exceeding 5 lakh, which means 1% TDS shall be applicable here. We have an example too. Let's do this. TPR & Co., a partnership firm selling its product X through digital facility provided by MKY Limited, an e-commerce operator. MKY Limited has credited its book of accounts and the account of TPR & Co. on 31st January by a sum of rupees 4,80,000 out of 4,80,000 for the sale of product X made during the month of January 2021. Sorry, out of 4,80,000, 4,300,000 is being paid on 3rd February, and Mr. Pavan has directly paid 40,000 to TPR & Co. on 15th January. Which statement is correct? So please note, totally 4,80,000 has been credited. Out of that, 4,300,000 is being given on 3rd Feb, 40,000 is given directly, and balance looks still probably payable. So here they will have to deduct tax. Tax shall be at what rate? Tax shall be at what rate? Anyone? Yes, tax shall be at what rate? 4,80,000 is this MKY credited, and they're also getting a direct amount of 40,000. So whatever is directly received, even that would be a deemed credit. So when the facility e-commerce operator will have to even deduct tax on it. This becomes 5,20,000. Your rate is 1%. But is it falling within the gap of your 14th May to 31st March? Yes. Then give 75% of it, or rather into 0.75%. Calculate this, you should be getting 5,20,000 0. 3,900. So 3,900 will be your answer here. Let's go on to the next one, TCS amendments. Here the amendments are again in terms of the same rate from 14th to 31st. We are giving a rate breakup. Except for alcohol, which remains constant, everything else will take 75% of the existing rate. Even your lease of parking lot, the second category, and your motor vehicle, third category, everything will take up 75% for the date from 14th May. So please be careful in your problems, okay? 14th May 2020 to 31st March 2021. Two new sections which have been introduced in TCS are these ones. In case there is an overseas remittance or an overseas store package which is being taken from 1/10/2020, tax shall be deducted. If it is a travel package or a tour package, no threshold. For every amount, TCS has to be collected at 5%. But if it is a remittance, then 7 lakh is the threshold. Okay, so up till 7 lakh, if it is a foreign remittance, no TCS shall be applicable. If it is more than 7 lakhs, whatever is the excess portion, on that 5%. If it is an educational loan, if it is for education purposes, any remittance that is happening there, then 0.5% of the amount which is in excess. This is 206C1G. 206C1H is your sale of goods if it is exceeding 50 lakhs. So to a single person, to a single party, to a single customer, if goods are sold more than 50 lakhs from 1/10/2020, we will have to now also collect TCS on them. Please note the rate is 0.1%. So when you put 75% of it, it becomes 0.075%. Out of habit, we might write 0.75, which will go completely wrong. You will have to write 0.075% and calculate accordingly. Okay. Whenever the consideration is received, so it's not at the time of sales when the consideration is received, the person will have to also collect for the TCS portion too. In case any other TCS section is applicable, any other TDS section is applicable, then 206(1)H shall not apply. If they are exporting, again, no TCS, because it is very difficult, to let the other foreign party pay taxes in your country. In case PAN or Aadhaar, now both of them have become interchangeable. In case it has not been provided, then collect higher of the tax rate of 1% or twice the specified rate, higher of. So these are your major amendments. Another amendment was the last date of linking up your PAN and Aadhaar. It was extended from 31st March to 30th June. It is further extended to 30th September as well. 194Q is your current year. Please don't get confused with whatever is now. Please stick to your previous year itself. If you have any other questions, please let me know. Or you want me to repeat anything, let me know. I will be sharing this PPT in the group also. Yes, if anyone has any doubt, want me to repeat any particular part, please let me know. If anything is not clear.
Ma'am, could you please explain the due dates again?
Okay. See, due dates have been, normally your due dates are 30th September for audit and 31st July for non-audit. This time what happened was, I don't know if you guys are aware about the Infosys issue which was happening. So there has been a new income tax website running now. And the migration from the old website to the new website took place sometime in this period. So people had a lot of difficulties, forms were not available, and filing was not being done properly. So since the forms came out late, very late, only recently, they have extended this to 31st December. So 31st July is now 31st December, and 30th September becomes 15th January for audit and 15th February for for your return filing. So anyone to whom tax audit is applicable, they have to furnish their return by 15th February, but the tax audit report should go by 15th January. Honestly, it doesn't make much of sense because when we submit our tax audit report, we normally file the return along with it. And this is the date now. Further extensions all depend upon what will be the situation then. But for every year, if in general you have to remember, for non-audit cases, 31st July, individuals who are not subject to any audit, 31st July. Other than that, 31st October. But 1 month before that, 30th September, you have to furnish your tax audit report. For filing of return, we get 1 month time. But filing of report, you have to do it earlier. So anyone who wants to take time to just pay taxes, probably they get 1 month time. Other than that, it doesn't make much of a difference. Any other doubt?
Ma'am,
Yes, Joseph?
can you explain capital gains in case of depreciable assets once?
Capital gains in case of depreciable asset. Okay. So in case of a depreciable asset, we go by the block of asset concept. Okay. So in case of block, say we have a plant and machinery block of 15%. Opening value of the block, opening WDV, happens to be 10 lakhs. And during the year, the sales, whatever machinery was there, everything supposedly has been sold for 12 lakhs. 2 lakh which remains will be treated as capital gain. Always short-term capital gain in case of depreciable assets. Okay, always short-term capital gain. Here what I'm saying, say there were two assets, A and B. And both the machineries have been sold for 12 lakhs. You have your short-term capital gain of 2 lakhs. Let me take up another scenario. Opening value, 10 lakhs. Two machineries, A and B. Machinery A is only being sold for 12 lakhs. We still have machinery B. Still, because your sale value is exceeding the block value, still there would be a capital gains. This will be a short-term capital gain, and the closing value, closing WDV of the block shall be nil. Even though you still have a machinery B in hand, closing WDV shall be nil. Let me take up another scenario. Opening WDV, 10 lakh. It has got two machineries, A and B. Both machinery A and B are sold for 4 lakhs. Now, there is no asset in that particular block. In this case, your closing WDV will become 0 because there is no asset. There's no point in keeping here. Difference is 6 lakhs. That 6 lakhs will now be your short-term capital loss. Capital gains in case of depreciable asset will arise only in two situations. First, if the block ceases to exist, if the block is not existing, that can happen when all the assets are sold. And in the second case, where the sale consideration is much more than the opening plus additions during the year. There is no monetary value left in the block. So in these two cases, capital gains will arise. It can be a gain, it can be a loss. Indexation is not permitted as far as your capital depreciable assets are concerned. Anything more specific that you need, Joshit, here?
That's it, ma'am.
Yes.
Thank you.
Any other doubt? If anyone has any other doubt, please let me know. One more thing that I would like to say here, your RTP for the relevant year, very important. And your mock question paper for the relevant year, very important. Please go through those things and all the amendments. If you just go through the amendments itself, major questions or the points in the questions will be somewhere related or connected to this. MCQs, most of them come from the amendments only.
194N, ma'am. If he has filed 3 returns, ma'am, then and exceed 1 crore, then what's the percentage for it, ma'am? 2%.
On the excess value, same thing which has happened in our example case. Yeah. Same thing. No?
Yeah.
She's filed all the return, even though she's filed belatedly, but she's filed it. So belated return is also equivalent to filing of return only. So here we take up again bank-wise and only on the bank withdrawal for that particular bank. Take up all the branches on that particular value which is exceeding 1 crore. So till 1 crore, no TDS. Anything which is over and above 1 crore, 2%.
Thank you, ma'am.
2%.
Ma'am, another thing, ma'am, 194K for UTI of mutual funds, everything is almost 5,000 is the limit now.
Yes, 5,000.
Like if anything which related to mutual funds, that's
Yes.
percentage.
Yes, anything which is now coming by way of dividend, it shall now be subject to TDS. Earlier, it was all exempt. Whatever dividend mutual funds were giving was all exempt. That's why there was no TDS here. But now, since it is taxable, we need a counter TDS sections too. 5,000 is the threshold. So if they're giving 5,000 rupees, no TDS. More than that, TDS shall be applicable. But please be careful on your rate and your 75% applicability. This batch will have to be especially careful on your 75% applicability. Your entire answer will change if you go by a wrong application. Like here, 5,200 will confuse you in a moment. But please remember, you have to apply the 75% there. Any other questions here? Also, your this portion. Formula application of 194. Recognized Provident Fund portion. This one, since it is a new one, not even there for the one who wrote in June, please be careful. It's very simple and small. Only the first part of the formula is what you have to understand. This is again very important, okay? Your calculation of average and everything, very important here. I hope all of you have understood this part too. Any other doubt? So I'll share this PPT with you all in the group and also give you the link for the session as well. Let's wrap up the session here. If you have any doubt, you can always message me and ask me. Don't expect an immediate reply though. Thank you all so much. All the best, guys. Do well.
Thank you, ma'am.
Yes.
Thank you, ma'am.
Thank you all. Please do well.
Thank you, ma'am.
Sure, all of
Thank
you will
you,
get
ma'am.
it.